Imagine waking up one day, and the entity that's been quietly lending money to the entire world for over 30 years suddenly asks for it all back. Not just a few million, but a scale of wealth so astronomical, it literally underpins the global financial system. Welcome to today's Explainer. We're going to skip the usual pleasantries right now because we've got a high-stakes financial mystery to unpack. We are looking at a quiet institutional cash drain that's fundamentally rewiring global markets and is happening right under our noses. This is the story of the yen carry trade.
So, to understand this anomaly, let's cast our minds back to August 2024. Out of nowhere, the Japanese Nikkei index dropped a staggering 12% in a single day. That was its biggest plunge since 1987's Black Monday. The S&P 500 fell 3% that exact same morning, and the VIX, Wall Street's fear gauge, well, it spiked to 65. Everyone called it a flash crash, but it wasn't a random event, and it definitely wasn't a glitch. It was a structural warning shot, a massive shockwave from a highly leveraged system that was just beginning to crack under pressure.
Now, this idea completely flips what we thought we knew about Japan's recent stock market surge. You see, shortly after that crash, the Nikkei started slamming into unprecedented all-time highs, eventually hitting 71,250. Financial media celebrated it as this huge domestic economic boom, but the shadow data? It tells a totally different story. This isn't a bull market signal driven by Japanese fundamentals. In fact, corporate profits are actually being squeezed by energy costs right now. No, this record high is a symptom of global capital being forced to liquidate U.S. holdings and flow back home. It's essentially the destination address for repatriating capital.
$29.6 billion. Just take a second to process that. That is the sheer scale of U.S. government and agency bonds that Japanese investors dumped in the first quarter of 2024 alone. It's the largest quarterly reduction we've seen in nearly 4 years. And honestly, this establishes the true urgency of what we're talking about today. The structural buyer of last resort for U.S. Treasuries is quietly, methodically becoming a seller.
Moving into Section 1, Japan, the world's ATM. Let's take a look at the actual mechanics of the yen carry trade.
The plumbing here is brilliantly simple. For decades, Japan had essentially zero interest rates. So global hedge funds and institutional investors figured out this amazing, almost risk-free loop. Step 1, you borrow in yen at next to nothing. Step 2, convert those yen into US dollars. Step 3, deploy that capital into high-yielding American assets like treasuries, long-duration bonds, and high-growth tech stocks. And Step 4, literally pocket the spread. When the difference between what it cost to borrow in Japan and what you could earn in America was 4 to 5 percentage points, institutions loaded up on this trade with absolutely everything they had.
Think of it like this. Imagine your house's boiler is completely busted and it's freezing inside. But instead of paying to fix your own boiler, because let's face it, the house won't warm up anyway, you decide to pay for your neighbor's heating system. Why? Because they offer you a fantastic return on your investment, and honestly, your boiler was a lost cause. Well, that was Japan. For 30 years, domestic economic growth was stagnant, so Japanese megabanks, life insurance, pension funds, and even individual investors sent their money overseas to fund American tech, Australian mines, and European real estate.
All right, Section 2, the 40-year setup. To truly grasp why the world's ATM is closing its doors, we've got to flash back 4 decades.
The dominoes actually started falling way back in September 1985, when the G5 finance ministers met at the Plaza Hotel in New York. The U.S. was facing massive trade deficits because high-quality, cheap Japanese goods, think Toyota, Honda, Sony, were just dominating the American market. So the U.S. essentially forced an agreement called the Plaza Accord to weaken the dollar and strengthen the yen. That triggered a massive domestic bubble in Japan that violently burst in 1990. To save the economy, Japan pushed rates lower and lower, eventually culminating in actual negative interest rates by 2016. And that policy lasted right up until the dramatic pivot we saw in 2024.
The immediate aftermath of that 1985 accord is just staggering to look at. The yen moved from about 240 to the US dollar all the way down to 120 in just 2 years. The yen's value doubled practically overnight. Now, imagine you're a Japanese CEO exporting cars to the US. Overnight, your revenue is cut in half, but your factory costs, they stay exactly the same. This sudden shift completely crushed Japan's export competitiveness. To prevent a total economic collapse, the Bank of Japan was forced to slash its policy rate down to 2.5%, just flooding the market with cheap money.
Now, that cheap money created a domestic asset bubble that eventually popped, resulting in what we now call the lost 30 years. The domestic pain was immense.
It took 34 years, literally until 2024, for the Nikkei to finally recover its 1989 high of 38,915. And during this exact same 30-year period, OECD data shows Japanese wage growth was practically zero. Meanwhile, over in the US, wages grew by 150%. This stark contrast is exactly why Japanese money had absolutely no choice but to flee offshore in search of any kind of yield.
Which brings us to the sheer scale of the plumbing today. According to Morgan Stanley, even after the recent market shocks, there's an estimated $500 billion in these yen carry positions still outstanding. $500 billion of leveraged capital currently floating around the global system, built entirely on the assumption that borrowing in Japan will always be practically free.
Moving on to Section 3, the tap starts charging. That foundational assumption? It completely broke in early 2024 when the Bank of Japan officially ended its negative interest rate policy and actually began hiking rates. You know, for a highly leveraged hedge fund, shrinking margins basically equal pure panic. At the peak of the carry trade, investors enjoyed a massive 525 basis point differential. But as the Fed holds steady and the Bank of Japan hikes, that margin compresses. When you are leveraged to the hilt, a shrinking profit margin means your trade is fundamentally at risk. And let me tell you, the exit door for a $500 billion trade is simply not wide enough for everyone to fit through at once. The rational move is to get out first.
Let's use a free water tap analogy here. Imagine a town where a water tap has flowed completely free of charge for 30 years. Entire industries, farms, people's whole lives were built around this free resource. Then, one day, the owner says, "Okay, I'm going to charge a tiny fee." The fee itself might be super small, but the structural direction has irreversibly changed. The era of free is over. That is exactly what the Bank of Japan did. A fraction of a percent increase seems tiny, but reversing a 30-year structural flow of global money, that triggers massive, immediate liquidations. And hey, the Bank of Japan isn't hiking just for the fun of it. After decades of relentless deflation, Japan's consumer price index has firmly crossed the 2% target and is hovering right around 3%. Because of this, Japan's 10-year government bond yield has climbed to around 2.6%. This is a total game changer. It means Japanese life insurers and pension funds can finally earn competitive, safe returns right at home, without taking on all the currency risk of investing in America. They just don't need the carry trade anymore. This brings us to Section 4, the Great Unwind. So here's the crucial point, the final domino effect. What actually happens when $500 billion starts aggressively rewiring itself?
The contagion from this unwind hits four major global impact zones. First up, U.S. Treasuries. TD Economics projects that Japanese repatriation could push U.S. 10-year yields 20 to 50 basis points higher, making American mortgages and corporate borrowing a lot more expensive. Second, emerging markets. Entire manufacturing bases in Southeast Asia, like Thailand's auto industry, which, by the way, is 90% Japanese brands, rely heavily on Japanese capital. Third, global commercial real estate in cities like New York and London are definitely going to face selling pressure. And fourth, exchange rates. As dollars are sold off to buy yen to repay those loans, the currency markets are going to face massive, massive volatility.
Bringing this directly back to your portfolio, when a global fund unwinds a carry trade, they can't just sell random assets. They have to sell exactly what they bought with that borrowed yen. And what did they buy in 2021 and 2022? The highest yielding, most liquid U.S. assets available. Long-duration treasury bonds and big-cap, high-multiple technology stocks. Make no mistake, the carry trade is an American asset story wearing a Japanese costume. The selling pressure is going to hit the Nasdaq just as hard as the Nikkei.
If you want to know when the next big shockwave is coming, seriously, write this number down, 155. Specifically, the USD-JPY exchange rate. Even after the recent rate hikes, the pair has spent a lot of time holding near the 160 mark, which basically tells us that the most acute phase of the unwind hasn't fully hit yet. But if the dollar-yen trade breaks and holds below 155, market mechanics dictate that the massive asset sell-off is accelerating. Watch that 155 level like it's your own portfolio, because mechanically speaking, it kind of is.
But it's absolutely important we look at the flip side impartially here. While global liquidity shrinks, 30 years of money flowing home is sparking a genuine, tangible domestic renaissance inside Japan. Warren Buffett has famously poured billions into Japanese trading houses. Toyota recently recorded an unprecedented 5 trillion yen operating profit, which is a historic first for a Japanese company. And foreign direct investment is really returning, highlighted by TSMC building a massive new semiconductor factory in Kumamoto. For Japan, the blood flow is finally returning to the domestic economy.
Which leaves us with the ultimate question. The 40-year structure that provided endless cheap capital to the global financial system is officially reversing. The warning shots have been fired, the plumbing is backing up, and $500 billion is looking for the exit door. As the world's ATM finally closes its doors, is your portfolio prepared for the great unwind? Thanks so much for joining me for this explainer. Keep your eyes on the data and never stop questioning the structure beneath the surface.